If your 401k is still positioned like it's 2019, you're walking across a burning bridge, and you don't even smell the smoke yet. You feel it already. Groceries cost more, but your paycheck didn't double. Your mortgage or rent is heavier, but your job doesn't feel safer. The news keeps saying soft landing, but every person you actually know is cutting back, taking second jobs, or quietly raiding their savings. That disconnect isn't an accident. It's what the end of a cycle feels like, right before the numbers finally catch up with reality. In 1929, they called it the Roaring Twenties, right up until the floor gave way. In 2007, it was the Great Moderation, right before housing imploded. Today they call it resilient, strong, soft landing. But the math behind Recession 2025 doesn't care what word they use. Here's the brutal part no one tells you on TV. Most Americans are not going into Recession 2025 as spectators, they're going in as collateral. Because your 401k, your IRA, your home, your job, almost everything you've built over decades, is tied into a system that's now running the exact same script we saw before 1929 and 2008, just on a bigger scale, with fewer exits. And the worst part? You did everything right. You worked, you saved, you contributed to your retirement plan, you trusted the system. But the system changed the rules, quietly, while you were busy living your life. Recession 2025 is not some random maybe. It's what happens when three bubbles, stocks, housing, and government debt, all stop pretending they can defy gravity forever. And if that still feels a little abstract, the next few minutes will make it painfully clear why your 401k is sitting in the blast radius of all three at once. You're not in a normal cycle. You're standing in the middle of a three-way collision, and your retirement account is strapped to the hood of the car. Let me show you what that actually looks like in numbers, not feelings. Stocks are expensive, housing is insane, government debt is a bonfire, and your 401k is tied to all three. Let's start with the piece everyone worships, the stock market. The S&P 500 is trading at valuations we only see at the top of bubbles. A handful of names, the so-called Magnificent Seven, now carry an insane share of the entire index. If a few of them stumble, the whole market doesn't correct, it buckles. Now ask yourself a simple question. What does your 401k actually own? Most people can't answer that. They just know they in a target date fund or in the 2045 retirement option. But peel back the label, and it's usually the same thing. Broad US stock funds, bond funds, maybe a sprinkle of real estate. In other words, your future depends on the very markets sitting at late-stage bubble valuations. Now layer on real estate. Home prices sitting massively above long-term trends. Commercial buildings half empty, but still carrying yesterday's cheap money debt. $2 trillion in commercial loans needing to be refinanced at double or triple the interest rate over the next couple of years. You might not own an office tower, but your bank does. Your REIT fund does. Your diversified 401k does. When those buildings can't cash flow at 7 to 9% interest, owners stop paying. When owners stop paying, banks eat losses. When banks eat losses, credit tightens. And when credit tightens in a debt-addicted economy, earnings drop, layoffs start, markets fall, and your retirement account bleeds from all sides at once. Then there's the third bubble, government debt. The thing everyone was told is risk-free. The federal government now owes so much that the annual interest bill alone is larger than entire departments of the budget. To keep the game going, they have three options: slash spending and trigger a deep recession, hike taxes and choke what's left of growth, or print more money and torch your purchasing power through inflation. Pick any path and your 401k feels it. Stocks reprice lower, bonds get hammered by higher yields, or the dollars your account is denominated in quietly buy less and less each year. This is why Recession 2025 is not just another downturn. In 1929, stocks were the main problem. In 2008, housing and credit were the detonators. This time, the entire structure, stocks, housing, bonds, and the debt-soaked government behind them, is wired together. And the typical American retirement account? It's plugged into all of it at the same time, under the comforting label, diversified. But here is the good news buried inside that nightmare. Every time we've seen a setup like this in history, a small group of people didn't just survive. They walked out of the wreckage owning more. The difference wasn't luck. It was the playbook they followed before the crash hit. That's what we're going to steal next. Every great crash in history has two stories. The loud one everyone remembers, the panic, the bankruptcies, the headlines, and the quiet one very few talk about, the group that positioned early, stayed liquid, and picked up assets for pennies while the world was suffocating. That second group didn't win because they were geniuses. They won because they understood one truth. Crashes don't destroy wealth. They transfer it, and they transfer it fast. Look at 1929. Most people remember the falling stock tickers, the breadlines, the decade of pain. But hardly anyone remembers the people who stayed in cash while valuations were insane, then bought businesses, land and stocks at 80–90% discounts. They didn't predict the bottom. They simply didn't drown with everyone else. So when the tide finally dropped, everything valuable was sitting on the beach, waiting for them. The same thing happened in 2008. While the news talked about millions losing homes, there was another story silently happening in the background. People with cash, courage, and patience buying properties at foreclosure prices and watching them 3–5x over the next decade. No secret, no magic timing, just preparation. Japan's 1990 collapse tells the same story. Their stock market fell 80%, housing fell 60%. But the people who didn't over-leverage, who didn't chase the mania, they weren't destroyed. They survived. And survival meant opportunity. Now here's the twist. All three crashes had one thing in common. The survivors didn't listen to mainstream advice in the year leading up to the collapse. Because before every major crash, the narrative is always the same. Soft landing. Things will stabilize. Long-term investing always wins. And then the floor gives way. History isn't repeating in 2025, it's compressing. Faster, tighter, with more leverage, and with far more people exposed through their retirement accounts than any time in the last century. In 1929, only the wealthy owned stocks. In 2008, homeowners took the hit. In 2025, everyone is tied to the same machine. Your 401k, your bank, your mortgage, your employer, your government, all carrying debt, all depending on cheap money that no longer exists. In the terrifying part, the quiet minority who will walk away richer already started preparing. Not with predictions, but with positioning. But the majority is still operating on advice built for a world that no longer exists. And those outdated beliefs are exactly what makes people victims during a wealth transfer. It's time to break them, brutally. The advice that built your parents' retirement is the same advice that could destroy yours in Recession 2025. Let's start with the most sacred cow. 60–40 portfolios. Stocks, 60%. Bonds, 40%. Safe, balanced, time-tested. Except this model only works when stocks and bonds move in opposite directions. But in the past few years, they've been falling together. Why? Because both are priced off the same thing, cheap money. Take the cheap money away, they collapse in sync. So the entire foundation of balanced investing evaporates the moment inflation enters the room. That's why 2022 nuked both sides of the portfolio. That wasn't a bad year, that was a preview. Next belief. Just keep buying the index, it always comes back. Yes, in the United States, during the greatest period of global dominance humanity has ever seen. But the math doesn't work when valuations are stretched, debt is record-breaking, demographics are aging, and productivity growth is slowing. Japan's stock market took 34 years to return to its old highs. If you're 55, do you have 34 years? If you're 35, do you want to waste your prime earning decades waiting? If you're 25, do you want to DCA into the peak of a bubble and spend the next decade underwater? Then comes the most dangerous belief of all. The Fed will save us. That belief was true in 2008, it was true in 2020, it is not true now, because the Fed cannot cut rates to zero again without detonating inflation. They cannot print trillions again without destroying the dollar's credibility. They cannot bail out every market at once when debt is already suffocating the system. Their toolbox isn't empty, it's radioactive. Using it makes the problem worse. So what happens when people follow old advice in a new environment? They walk straight into the buzzsaw. They hold the wrong assets at the wrong time. They trust the wrong institutions. And they wake up one morning realizing their retirement plan wasn't diversified. It was concentrated in one single bet, that the system would stay stable forever. It won't. It never does. Every empire, every currency, every financial structure eventually resets, not because of politics, not because of conspiracy, but because math always catches up. And when it does, one group gets destroyed, the group still clinging to the old rules. The group that survives and even climbs is the group that accepts the new reality early and adjusts before the crowd. So if the old playbook is dead, what actually works now? This is where survival finance begins, and where your 401k stops being a liability and becomes a weapon. The next section is the part most people wish they knew before every major crash in history. Collapse only kills the unprepared. Everyone else uses it to upgrade their position on the board. That's why Recession 2025 is not just something to protect yourself from. It's the reset moment the system didn't schedule, but history always delivers. And in every reset, the people who enter with clarity walk out with leverage. So here's the part no one on mainstream TV will ever say. Your 401k isn't doomed, it's mispositioned. Fix the positioning and the crash becomes an opportunity instead of a threat. And the simplest way to do that is with a 3-layer survival portfolio, built for the world we have now, not the world your parents retired in. Layer 1, survival. The first 6-12 months before any portfolio discussion, you need to survive the liquidity shock. Crashes don't just destroy markets, they freeze cash flow, layoffs spike, credit lines vanish, banks tighten, borrowing costs explode. If you have no buffer, you become a forced seller, and forced sellers always lose the most. So the survival layer is simple. 3 to 6 months of living expenses in cash or T-bills. Pay off high-interest debt, credit cards, auto subprime. Create redundancy, food, meds, emergency reserves, a local network. Not because the world is ending, but because liquidity is oxygen when the system buckles. People who have it make calm decisions. People who don't make desperate ones. Once survival is secured, you earn the right to defend what you've built. That's where Layer 2 comes in. And this is where most Americans get it wrong. Layer 2. Defense. Protecting your 401k from systemic damage. This is where we stop pretending diversification means owning 12 funds that all collapse together. Real defense is about correlation, not quantity. If everything in your portfolio moves in the same direction during stress, that's not diversification. That's a costume, a disguise, a trap. Here's the blunt truth most people don't want to hear. If your 401k is 70-90% tied to US equities and long-duration bonds, you are not diversified. You are concentrated in the exact structure that Recession 2025 is targeting. Defense means 3 things. 1. Shorten duration. Long-term bonds get obliterated when yields rise. Short-term T-bills give stability without pretending to be safe. 2. Reduce overweight US megacap concentration. If 30-40% of your retirement is effectively sitting inside 7 companies, that's not a portfolio. That's a hostage situation. 3. Add true diversifiers, real assets, commodities, select international exposure, defensive sectors, and yes, for many people, a slice of precious metals exposure for currency risk. You don't need to gamble. You don't need to predict. You only need to stop letting your entire retirement depend on the most overvalued corner of the global market. That alone separates survivors from casualties. And once defense is set, you'll be ready for the part no one teaches, the part the wealthy quietly execute every single cycle, offense during chaos. Layer 3, offense, turning the crash into your advantage. This is where the wealth transfer happens, where the people who didn't position early are forced to sell, and the people who did step in. You don't need millions, you don't need perfect timing. You just need to not be drowning when the tide drops. Offense means having cash or safe liquidity, a shopping list, the patience to wait for real discounts, the courage to act when everyone else is terrified. Because every crash in history eventually reveals the same truth. The best assets are always held by the wrong owners at the wrong time. When the pressure hits, those owners sell them cheap. The people with clarity pick them up. Your shopping list should focus on quality. Real businesses with cash flow, strong balance sheets, low debt, essential industries, hard assets with real utility. Opportunities where fear misprices reality. The goal isn't to call the bottom. The goal is to recognize when forced sellers start capitulating and step in with discipline, not emotion. This is how people in 1933 built generational wealth from the ruins of 1929. This is how investors in 2010 made fortunes from the chaos of 2008. This is how Recession 2025 becomes an opportunity instead of a graveyard. And if this sounds extreme, it's because most people only see crashes when they're already inside them. You're seeing it before it hits, which means you can position before the crowd. The system is not designed to save you. At best, it uses you as shock absorption when it resets. But once you accept that, you stop waiting to be rescued and start acting like someone who plans their own escape route. Recession 2025 is not a mystery anymore. The signals are loud, the math is clear, the playbook is written. The only question left is simple. Which role are you preparing to play? The liquidity for someone else, or the one collecting the assets after the panic? Fix your 401k now. Secure survival. Build defense. Prepare your offense. Because the people who do this early walk into the crash with fear in their stomach and walk out with leverage in their hands. If you want the exact checklist I use to know when it's time to move from defense to offense, subscribe, because the next video breaks down the 3 signals that tell you the system has entered the buy zone.